What if your own government was quietly doing the one thing that could send gold and silver to levels most people can't even imagine right now? We are watching some incredible developments unfold at the same time: critical mineral policy, direct comments from the US Treasury Secretary about gold, and a currency intervention most people have never even heard of. By the end of this video, you will understand why all of these separate stories are actually pointing in the exact same direction. Stay with me because today's breakdown connects dots that most financial media is not connecting for you. Welcome back to Macro Bullion. I'm Alex James, and this channel exists to break down the global economy, gold, silver, and central bank policy using verified data, not hype. Let's start with something that went a little under the radar. Earlier this year, the Trump administration signed an order using authority under the Defense Production Act to allow export restrictions on certain industrial materials, aimed at retaining critical minerals and rare elements inside the United States. Silver was added to the official U.S. critical minerals list back in November of last year by the U.S. Geological Survey. To be clear, this order did not specifically name silver, and there is no confirmed price floor policy for silver, despite some social media speculation about that a few months ago. But the order is part of a broader pattern of the U.S. government trying to secure supplies of critical materials needed for advanced technology and defense manufacturing, and silver sits directly inside that category. Here is why that matters. Silver is officially a finite resource, and above-ground supply estimates vary widely depending on the source. What we do know from industry data is that global silver demand has outpaced mine supply for several consecutive years, creating a structural deficit that miners cannot simply fix by producing more, since new mine supply takes years to develop. When a government starts treating a metal as strategically important enough to restrict its export, that is a meaningful signal about how tight the physical market has become, separate from whatever the paper futures market is doing on any given day. And that brings up an important distinction verified by exchange data. On the COMEX, paper-silver trading volume can run extremely high on any single day, at times equal to a meaningful share of annual global mine production of roughly 800 million ounces a year, according to Silver Institute estimates. That is, paper contracts, not physical metal changing hands. The point is not that paper trading is fake, but that physical silver, the metal actually being mined, refined, and used in industry, is what ultimately has to back up all of those paper claims over time. As government attention shifts toward physical critical mineral security rather than exchange contracts, it reinforces the idea that the real story is in the physical market, not the daily price swings on a trading screen. Now let's talk about background, because to understand where gold and silver are heading, you need to understand how we got here. For decades after the Bretton Woods Agreement of 1944, the US dollar was directly tied to gold at a fixed rate of $35 per ounce, and other major currencies were tied to the dollar. That system gave the world a stable, gold-anchored foundation for international trade until 1971, when President Richard Nixon closed the gold window and ended the dollar's direct convertibility into gold. Since then, the world has operated on a fiat system, where currencies are backed by confidence and government credit rather than a physical metal. But this background became directly relevant just recently. U.S. Treasury Secretary Scott Bessent has made a series of public comments in 2026 confirming that the gold held at Fort Knox and other U.S. facilities, roughly 261.5 million ounces in total, according to Treasury and U.S. Mint figures, remains fully accounted for. Bessent also pointed out something important. On the Treasury's own books, that gold is still valued at the outdated statutory price of $42.22 per ounce, a number set decades ago, while the same gold is worth well over $1 trillion at today's market price of roughly $4,040 to $4,055 per ounce. Bessent has also spoken publicly about the historical role Bretton Woods played in global prosperity and has referred to the current environment as a kind of Bretton Woods realignment. According to comments reported earlier this year, these are his actual public remarks, verified through Treasury statements and multiple financial news outlets, not speculation. Now, here is the problem this creates. The United States and much of the developed world is carrying historically high levels of government debt, while interest rates on long-term government bonds have been climbing. The 30-year U.S. Treasury yield has moved into territory not seen since 2007, based on recent Treasury market data, and that matters because rising long-term yields usually reflect the market demanding more compensation for the risk of holding government debt for that long, often tied to inflation expectations. When investors expect inflation to run high for years into the future, government bonds start to look less like a safe haven and more like a risky bet on the value of paper currency itself. This is the real problem underneath all of these individual headlines. A government with rising debt, a Treasury Secretary drawing public attention to how undervalued official gold reserves are on paper, and a critical minerals policy that includes silver are not three unrelated stories. They reflect a broader shift in how governments themselves are starting to think about the role of hard assets in an environment where confidence in long-term government debt is being tested. None of this means a return to a formal gold standard is coming, and nobody, including Bessent himself, has confirmed that as policy. But it does show that gold's role as a form of national collateral has not disappeared. It has simply been sitting quietly on the balance sheet while the world's central banks quietly bought more of it. Let's move into the actual content of what's driving this market because the data here is genuinely significant. According to the World Gold Council, central banks worldwide have purchased an average of roughly 1,000 metric tons of gold per year over the past several years, which is close to double the average pace seen in the decade before that. This buying has come from a wide range of countries looking to diversify away from being overly concentrated in US dollar assets, and it is one of the clearest, most consistent forms of demand supporting gold prices in this entire cycle. This is not analyst speculation, it is verified purchasing data reported by central banks and compiled by the World Gold Council. There is also a well-known economic framework worth understanding here, sometimes called the liquidity pyramid, originally developed by economist John Exeter, who spent years working in the field of monetary economics. The idea is simple. Physical gold and silver sit at the narrow base of the financial system, while paper assets like currency, government bonds, corporate bonds, stocks, and derivatives sit in expanding layers above it. In periods of confidence and economic growth, capital tends to flow upward into riskier paper assets. In periods of financial stress or declining confidence, capital tends to flow back down toward the base, toward gold and silver, which is one reason precious metals often perform well during periods when trust in paper currency and government debt is being questioned. Now let's connect this to actual market performance because the numbers here are genuinely striking. Long-duration U.S. Treasury bond funds, which are supposed to represent one of the safest possible investments, have lost a very large share of their value over the past several years as interest rates climbed. Over roughly the same period, silver has moved from around $20 per ounce to trading near $57 to $58 per ounce as of early August 2026, based on live pricing from major bullion dealers. To put that in perspective, using simple numbers, $100,000 invested in a typical long-duration Treasury bond fund 5 years ago would today be worth meaningfully less than what you started with, while the same $100,000 invested in physical silver over that same period would be worth well over double what you started with. This is historical performance only, not a guarantee of future returns, and DYOR before treating past performance as a forecast for what comes next. Gold has told a similar story, climbing roughly 120% over the past 5 years according to market data, and reaching an all-time high above $5,589 per ounce in late January 2026 before pulling back to today's range, near $4,040 to $4,055 per ounce. Some major Wall Street banks have published aggressive forward price targets, including JP Morgan's published target of $6,300 per ounce by the end of 2026, while JP Morgan's CEO Jamie Dimon has publicly said gold could reach $10,000 per ounce under the right conditions. These are the bank's own published forecasts, not guarantees, and gold, like any asset, does not move in a straight line. Now for the analysis, and this is where we need to bring in the Japanese yen story, because it connects directly to everything we just covered. Reports from Reuters and the Financial Times indicate that the U.S. Treasury intervened in currency markets recently to help support the Japanese yen, which had weakened to levels not seen in roughly 4 decades. According to the Financial Times, the Federal Reserve Bank of New York sold euros to buy yen on the Treasury's behalf, executed through major banking partners, marking what was reported as Washington's first yen-supporting intervention alongside Japan in more than 10 years. This is a verified, sourced report, not speculation, though as always with reported intervention details, exact amounts have not been officially confirmed by the Treasury itself. Why does this matter for gold and silver specifically? Because currency intervention of this size and rarity is usually a signal of real stress somewhere in the global financial plumbing, not a routine event. When a major government has to step in to defend another country's currency, it tells you that policymakers are worried about how disorderly the alternative outcome could be, whether that is a disorderly carry trade unwind, disruption in the U.S. Treasury market, since Japan remains one of the largest foreign holders of U.S. government debt, or broader instability in global currency markets. None of that is good news for confidence in paper currencies generally, and historically, periods of currency stress and central bank intervention have tended to support demand for gold and silver as alternatives outside the traditional banking system. Let's also address the silver technical picture directly because there has been real concern in the market recently. Silver's 50-day moving average recently crossed below its 200-day moving average, a pattern traders call a death cross, which is traditionally viewed as a bearish technical signal. Silver has also traded in a fairly sideways, choppy range for weeks, hovering below the $60 level. It is accurate and important to acknowledge this technical weakness rather than ignore it because presenting only the bullish case would not be honest, balanced analysis. At the same time, technical signals like a death cross do not automatically predict future price direction with certainty, especially in a market where physical demand fundamentals, central bank buying, and currency instability are pulling in the opposite direction. This is exactly the kind of moment where short-term technical charts and longer-term macro fundamentals can tell two different stories, and disciplined investors need to understand both rather than reacting to just one. Broader asset markets add more context here too. Long-duration government bonds have shown historically poor returns in a rising rate environment. Broad stock market valuations, by many traditional measures, are elevated relative to historical norms. And real estate in many markets has also cooled from its recent highs. When multiple traditional asset classes are simultaneously showing stress or elevated risk, it naturally increases investor interest in assets outside that traditional system, which has historically included gold and silver. Let's bring this together with a realistic prediction. None of the individual stories we covered today, critical minerals policy, Bessent's comments on gold reserves, record central bank buying, or the yen intervention, prove on their own that a dramatic new monetary system is coming. But taken together, they paint a consistent picture. Governments and central banks are treating physical gold and increasingly silver as strategically important in a way that goes beyond simple investment demand. That is a meaningful shift in tone from officials who, until fairly recently, rarely spoke publicly about gold at all. Here is what the verified data actually supports today, without exaggeration. Gold is trading near $4,040 to $4,055 per ounce as of early August 2026, up roughly 120% over 5 years, after touching an all-time high above $5,589 in January 2026. Silver is trading near $57 to $58 per ounce, despite a recent bearish death cross technical signal. Central banks have been buying gold at roughly double their historical pace. The U.S. Treasury has confirmed its gold reserves at Fort Knox and elsewhere remain fully intact, still valued on paper at a fraction of their real market worth. And the U.S. Treasury has intervened in currency markets to help stabilize the Japanese yen for the first time in over a decade. Everything beyond those confirmed facts, including specific future price targets like $30,000 or higher for gold based on historical debt-to-gold ratios, remains theoretical analyst modeling. Interesting to consider, but not something to treat as a forecast. My own outlook stays balanced. The combination of record government debt, rising long-term bond yields, aggressive central bank gold buying, and now direct currency intervention all point toward continued structural support for precious metals through the rest of 2026. At the same time, silver's technical picture shows real short-term caution signals, and both metals can pull back sharply even within a longer-term uptrend. Managing position size and understanding your own risk tolerance matters just as much as being right about the long-term direction. If you found this independent breakdown valuable, make sure you subscribe to Macro Bullion and turn on notifications because we cover gold, silver, central bank policy, and the global economy every week using verified data, not hype. I'm Alex James, and my goal is simple: help you see the bigger macro picture clearly. Let me know in the comments, do you think this combination of signals means gold and silver are just getting started, or do you think the market has already priced most of this in? Before you go, one last reminder. This video is for educational and informational purposes only and should never be treated as financial advice. Gold and silver prices change constantly, so always check a live spot price before making any decision. The facts and figures shared today come from verified sources including the U.S. Treasury, the World Gold Council, Reuters, and the Financial Times, while specific future price levels remain analyst opinion. Always verify information across multiple reliable sources. Think about your own financial goals. Speak with a qualified financial professional if needed, and above all, DYOR. Do your own research before making any investment decision.